past, you might have had to put 5% down. It depended on the laws at the time.
Right.
So, yeah. So definitely a great option. All right. So now the meat and potatoes. Like I said, we're going to go through a quick example. I know it's riveting information, guys. But
a bunch of numbers.
It's important to know. It's important to know. So many people don't understand what their payment is actually paying. All right. So, scenario. I have a $250,000 mortgage with a 5% rate. Would love to have that for a 30-year term. So then my monthly principal and interest payments total out to be $1,342.05. So what does that mean? So let's go back to that real quick. And the interest. So if you're looking at it, the interest is the majority of that payment. The reason why that is, do you know the reason?
Because the interest is paid much more heavily up front in comparison to the back end of the loan. Because you spread out the interest and you front load it and then you back load the principal.
Well, yeah, it's that. And you haven't made a payment towards the principal yet.
Right.
So you're right. So we're paying over $1,000 in interest, and we're only paying $338 towards the principal. And then my remaining balance after that is, very little difference, but you are making a payment. So that's really when you look at what we were just looking at, that's when a mortgage loan officer tells you, hey, this is what the payment is. They should be telling you this is the P&I, or principal and interest payment. PITIA, principal, interest, taxes, insurance, and association dues, which would be HOA. That would be the more accurate number that you can expect, right?
Right.
Because if I only tell you the principal and interest number,
you're not getting the full cost of ownership per month.
Well, exactly. Yeah. If you don't have that, then I'm not telling you the whole truth.
Right.
Because I believe here in South Carolina, it's required by law on a principal or primary residence, you have to escrow everything.
Right.
So yeah, it's required, and that's why it's important for you guys to ask questions. How much am I paying in HOA fees when I'm looking for a house? How much am I paying for taxes each year? And then how much am I paying for hazard insurance? So,
right.
Yeah, that makes a huge difference. We're going to talk about more of those topics later in another episode. All right.
Your mortgage types.
Dude, I feel like I'm talking way too much, but
no, it's good.
Here we go.
We front loaded your half.
This is true. Okay, so these are the big ones, and there's so much more to be talked about in these because this is wave tops. We're not talking details. I wish we had more time to talk about each and every program, but I'm going to give wave tops. Okay, so 30-year conventional. You'll say Fannie Mae, Freddie Mac. Okay, so that is going to be the most common loan that's out there. It's going to have requirement of 3% down. There's going to be PMI if you do 3% down. With that being said, there's going to be a higher credit requirement for a conventional loan. And overall, it's just the most common. The rates are a little bit higher than a government loan, but they're what most people go for.
Who would you say that 30-year conventional is for?
Well, I would say really it depends. When I talk about 30-year conventional on here, there's a ton of programs that include that because FHA is a 30-year fixed, but a 30-year conventional, you have affordables programs that can work for clients who make below, a 80% or lower of the median household income in an area. But I would say it's really the average person. But it really depends though, man. I think the Fannie Mae, Freddie Mac, 30-year conventional, there's no one really, there are people who can be excluded from that if they have low credit scores and other issues of down payment.
Right.
But really it's the most common. I wouldn't say there's one bucket of people that I can
that it's for. That is your Your default option.
Yeah, it's the most common. It's what everybody, when they're asking about a mortgage, that's what they're thinking about. But I mean, there's a ton of different programs out there that include this conventional 30-year. I guess if we were going to sum it up, I would say, a first-time home buyer could fit in that, but a first-time home buyer could fit into most of these.
Right.
So, yeah. So then we've got FHA. FHA, do you know what that stands for?
Federal Housing something, right?
Administration.
Federal Housing Administration loan.
Yeah.
That's right.
Yeah. So the FHA, it is a government insured loan. It is it's not guaranteed, right? A VA loan is a government loan that's guaranteed by the Veterans Affairs. So that's actually why there's a big difference. But the rates are usually very similar.
Right.
Because the government-backed loan, it actually has a lower rate. But with the FHA loan, you have to put 3.5% down, and then you have mortgage insurance the entire time. It's mortgage insurance premium. It's not PMI. It's MIP.
Right.
You have to pay an initial upfront mortgage insurance premium that you can finance into your loan. But also, you're paying a larger down payment, and you're paying mortgage insurance the entire length of the loan unless you refinance it.
So this one doesn't have the option to get rid of that insurance.
No, it doesn't.
Whereas a conventional would. Yeah.
So you don't have the option. You're trading off, right? So you have some limiting factors of how you can use the FHA loan.
Right.
You can only use it on primary residences, and also you cannot use it over a certain amount. So the loan size is limited. There's no income qualified. Like you can't make over a certain amount and then you're not qualified. But you can only buy to a certain size of loan. I think it's like $545,000 here in Charleston.
Right.
Which I mean, buy is a pretty nice house, but it's geographically limited in its price or volume.
Right.
But I would say the FHA is great for first-time home buyers. You do have to bear in mind the pros and the cons. I'm paying mortgage insurance the entire length of the loan, and I'm paying, I think it's 1.25 or 1.15%. I'll have to double check on the numbers. Correct me if I'm wrong in the comments. I need to know how to do my job better. So the mortgage insurance premium that you pay up front, that can be significant. If you're financing it, that's cool, but that could also affect what you can qualify for.
Right.
So that being said, the pros is the lower rate, and the cons, I would say, is really the mortgage insurance the entire time, and then also the
price limitation.
The price limitation. There's three. Yeah, price limitation, and then the mortgage insurance premium you have to pay up front,
right,
which makes a big difference.
Especially in your closing costs, which we will get to later down the line.
Yes. Just like one we're working on now. So we've got VA loans. So crazy. I put a little graphic there with American flag and some keys. VA loan, Veterans Affairs, or Veterans Administration, my bad. So Veterans Administration, it is a loan that is guaranteed by the government. Once again, great rates.
Right.
I would say there's not very many cons, in my opinion. You get up to 100% financing, so that means 0% down the entire time of the loan, which is nice. You can avoid, there's a funding fee. So a veteran will know when they get a certificate of eligibility if they qualify to not have to pay that.
Right.
And that's usually if you're disabled. So that's how that works. But you can get a house with a VA loan if you're working with a really great seller.
Right.
You could buy a house with nothing other than like the credit application and an appraisal.
Right.
So that's insane. Obviously, it's for veterans or active duty service members.